Arch Lending is building the most transparent borrowing experience in crypto. Get industry-leading rates from 8.49% APR, borrow against Bitcoin, Ethereum, or Solana, and receive USD or USDC within minutes. Your assets stay protected with qualified custody, no rehypothecation, and verifiable segregated addresses. As your collateral grows, unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never on your own. Arch Lending, simple tiers, public pricing, market leading rates at every size. Check them out at archlending.com/debates. Again, it's archlending.com/debates. Use code debates to get 50 basis points off your APR on your crypto-backed loan today. Welcome to the debate room. We're going to be discussing what is the ideal portfolio in the age of digital credit. Hey, Dustin, how's it going?
What up? So, should I give my answer now?
What is your answer? Just put it all in Solana?
Probably 50% World Liberty Financial Token, another 25% in Pokemon cards, and the final 25%, I'm going to go with meme coins.
Yeah, I think that seems pretty solid. What do you think about that, Matt?
Kind of invincible, I think.
It's maybe a little more institutional than I like to be. It's a little bit more upscale. So I may adjust the weightings, but directionally correct. Depends on what's in the Pokemon mix. You know?
I mean, I'm a big Charizard guy. So
it's fair. There you go. I like it.
We got to go with the best. Right? None of these little guys. We're not trying to corner the market on some random one no one's ever heard of.
Right. Plain vanilla. I like it. Hard to argue.
Matt, super excited to have you here. Matt is the CIO of Bitwise. Can you let us know about yourself?
Sure. Yeah. CIO of Bitwise. Bitwise is a $15 billion global crypto asset manager. Been in the market for 8 years. So I've lived through some bull and bear markets while here at Bitwise. And before that, I spent a decade in the ETF industry as the CEO of ETF.com. So that's me in a nutshell.
We're pumped to have you. Thanks for joining.
Absolutely.
We also have Ben Workman, the CIO of Strive. Glad to have you.
Absolutely. I'm happy to be here. And I'm kind of hoping now that we might have a pack unveiling here. If Dustin's got a few Pokemon cards back there, we're going to see if he's a big winner and he gets to retire live on stream or not.
Oh, an unboxing show.
There we go. See,
that's what I'm talking
people
about.
what they want, Dustin.
That's right.
And Mike, how's it going?
Really good. Really good. I'm wondering if we should try to revive Terra Luna in the portfolio. That's the biggest question.
Did you recently make some bad investment decisions? Is that why you have a power out? It looks like you have a power outage right now.
Really? Do I need to open some blinds?
No, I'm kidding. I'm just making fun of you because you were talking about your lighting.
I mean, he's got internet.
I think I need to invest in better lighting. I don't know.
Some power.
This situation out maybe, but
yeah, no. Now that Do Kwon, right, like is back, like
Running
steady
back.
lads, like adding more capital. Let's freaking go.
Steady lads. Oh man.
It's amazing how many of those phrases stick in the lore around here.
Right?
They've been
Yeah,
around long enough.
That one I had chased from my mind, but you just brought it all back, Dustin. I appreciate that.
I had way too much Luna. Oh,
20%
an
basically
all-time
risk free,
tweet.
right, Dustin? Yeah.
although it's funny because this is actually like a relevant topic right now. Staking crypto for me has been a bad idea 99% of the time that I've done it.
I think the longer you end up staying in crypto and the more you go out that curve, and I was like that in the early days too. So for me, I was Bitcoin 2013 was kind of the first time that I got into it. But everyone has to do their heritage journey where you stray from the path and you spend a lot of time off there in meme coin land and in the wild west of crypto to really learn what's going on. And you go through enough cycles and you kind of become the boring guy. You know, you go, I've been down that road a million times. There's one thing that survives and stays at the top of the list all the way through. And it's just interesting how it shapes, at least, talking in a portfolio context, what you're willing to allocate to and what risks you're willing to take on. But the conversation's changed a lot, right? And I know Bitwise, you guys do a lot with some of these other coins. And I think it's interesting because it's just a different mindset, right? One of them you're looking at as more of a commodity style of an asset, and the others you're looking at more as technologies. And they both got their place and they both got their functions. And there's always this very passionate fight that's out there online regarding these, saying, it's always got to be either or, and it's an all or nothing and zero sum game. But the reality is that even in the crypto ecosystem, we're watching innovation unfold at light speed. You're just trying to pick what the winner is going to be, and we don't know yet. Right? What's going to take over for tokenization? Obviously, there's utility there. You're seeing equities moving into that. You'll see real world assets move into the tokenization. But to me, that's just a different segment in a portfolio, right? Bitcoin's something I can see as a base foundational asset because of the properties that it's hold. Whereas, I would view, more of the crypto style is more of like a venture style return seeking. You're out there sliding out the risk curve, betting on it, but you've got innovation risk. Someone can come out with a cheaper, faster chain, and it's all about timing and which one gains adoption. So, that market will play out the same, but it changes the way you think about things when you've gone through a few of these cycles.
Yeah, I absolutely agree with that. Just to build on that, people often ask me, is crypto an asset class? I like to tell them that it was, but I don't think it will be in the future. It's really these two separate things, as you said, Ben. There's Bitcoin, which is money, which has arguably an unassailable moat in that space. And then there's this technology space, which I find fascinating. Bitwise does do things in that space, but where all the things you said, Ben, are absolutely true. There's more technological competition. You can't assume that competition is the end of time. There's also market competition, regulatory capture competition. There are all these things that make that space much more complex and different risks. And I think over time, you're going to see different returns between the Bitcoin side of the portfolio and the other side of the portfolio. I actually think those correlations will slowly lower over time because they're really serving very different markets.
And I think you also see, periods like these that we just went through where you get these really brutal drawdowns, right? It has a way of pulling the hype out of the market. And you start to figure out what's actually building, where is there actually traction? Because it's easy to pick when everything's going up and to the right. It's why everyone always feels like a genius in a bull market, because you can it's throwing the dartboard at the wall, right? You can pick one and they all seem to go up and pump together, or you're rotating, trying to catch the next pump. But when you see these drawdowns, that's when it really makes you evaluate the landscape out there and look for what's making foundational process, right? What's actually building out those real world use cases? Where are you actually seeing uptake? What are institutions paying attention to? Where is it not just, speculative capital sloshing around in the market, right? Where are you seeing real investment being made? And it starts to separate out, what falls into that, more meme coin or highly speculative category versus which assets are out here, which, technologies are out here building real experiences and real utility that's going to be used out there in the market. And then it's always easy to default back to, well, when you look at this entire landscape, if you start with, capital and money as the base and you separate it and you take Bitcoin out of that conversation, you say this has been at this point proven to be a different thing. It lets you look at all of those different assets and technologies in a different light, and it becomes far less us versus them, because it doesn't necessarily need to be. Innovation is going to happen everywhere, whether people like it or not.
What do you think the biggest lie that investors are telling themselves right now when you speak to people?
Well, it started with this time is different. We just went through a market period here where I think a lot of us thought, myself included, that the market structure had shifted in such a way that we weren't going to see any type of cycle really play out. And it's possible that we're actually in that transitionary period right now with what we've been seeing, from strategy and stretch and the amount of demand that's coming into that and the amount of bid that's putting in under Bitcoin. That could fundamentally change the structure around that asset. But I think that there's always the desire, and I think it's human nature, to hope that you caught the rocket and you're going to ride it on the one time where it goes straight up forever, which doesn't happen. And so there's a lot of mental gymnastics that I think a lot of investors go through to convince themselves of that outcome, despite seeing evidence in the market to the contrary and being willing to adjust and pivot to that. And so it really comes down to what was your core thesis around whatever the asset is that you're holding, and has that changed? And what is your time frame? The biggest thing I always see is you've just got this mismatched time frame. They'll tell you that they're looking for things through a long-term lens, but long-term seems to have gotten shorter and shorter over the years. Now it seems like if someone's holding something long-term, they think that means 3 months instead of a decade. Right? We've gotten far more active in this space with portfolios than passive, which we used to be, in the past. And so I think that inability to, kind of take on the dead man's portfolio and be willing to allocate to something you strongly believe in and then sit on your hands and not force yourself to change positions all the time. I think that's one of the things that really impacts a lot of investors in their portfolios, and it chops them up in these markets when they really shouldn't be in there trading. So we've moved out, and I think that the ability to reallocate a portfolio regularly has become too commonplace for most investors, where most of them really do need to take a more passive approach, take their high conviction bets, and be willing to sit on their hands for a long period of time.
Matt, what do you think?
I would
Go ahead, Mike.
I just wanted to add one thing to that with the broader crypto space. As we've seen through the cycles, there's been very few things that have had any staying power long term. And to your point, Ben, of people becoming more passive and choosing the right things over a longer period of time rather than being speculative traders, it's been really difficult across the entire industry to figure out what actually has true value long term. The Ethereums, the Solanas. I mean, Solana only came out in 2019, so it hasn't even had multiple cycles to that degree like Ethereum. But as it always comes back, it's always Bitcoin stays at the top, and that's where the industry has moved. They've realized that, and that's why you're seeing all the products and the securitization and everything downstream of the asset itself. And so, to the earlier point of money versus technology, that's been the biggest debate in the space for many years. Is the difference between those two things: Bitcoin having monetary properties versus crypto being a technological play. Ultimately, you're seeing that with the stable coins, Solana and Ethereum, in the minting of all of those, and that's going to continue to play out. But I don't think you're going to have the accrual to the base layer that you've seen in the past cycles in value as like a long-term investment of holding Solana or Ethereum. So people are understanding that, and that's why we're going pretty deep in Bitcoin, and everything's being built out on that.
Headline: Mike Munns says buy Monad.
I don't know. Hyperliquid's looking pretty good.
Yeah, I mean, Hyperliquid's an interesting example of a NewCo project that was built in the post-Gensler regulatory era where value capture is more allowed, and it has a nice closed loop economic system. I don't think it invalidates the things that we were saying about these other projects, which have really challenged. I think they built something that makes some sense and has real world use case, and it's been valued by the world. I think that's probably like a direction of travel for crypto that we will see in the future. So I think it's a neat exception to the rule. That doesn't mean it has infinite staying power. It faces competitive risk, it faces regulatory risk, it faces technology disruption risk, has all of those same execution challenges, but they have built a nice closed economic system that I think is interesting. As far as the other lies people are saying, I agree that this time is different, turned out to be wrong. And I too thought the 4-year cycle would play out differently this time, and underestimated its reflexive nature and its emotional tie to people. I think that was very true. The other mistake on the more hopeful side is I also saw a lot of sort of despair maxing by crypto people, calling this winter worse than any other winter, or the situation desperate, which is just objectively untrue by any statistical or anecdotal measure you want to take. And I couldn't believe people were seriously making that argument, but they were seriously making that argument a couple of months ago. And I just, no one who lived through, let's say, the 2018, 2019 winter thought that this winter was worse than that. And really no one who lived through the FTX collapse thought that this winter was worse than that. So that's maybe the other lie people have been telling themselves.
I think it might actually play into it though, because in a lot of those other cycles that we watched, people at least had something to point to. And I think that was what confused a lot of them about this recent drawdown, was there was no, black swan event like an FTX collapse and the contagion that spread through that one that caused it. So I think it might have almost caused people to go into, despair was a good word. Crypto and Bitcoin, it has a way of eating its own, right? People will turn on each other during certain market conditions. You find that out pretty quickly.
Yeah.
But I think that there's almost some emotional value to investors when they at least have an event to anchor to. And it feels like it takes the responsibility off of you for where you were allocated. And you go, well, it went down, but it wasn't my fault because this happened, right? There's emotional games that you play to justify things like portfolio performances over time. And it's one of those where this one may have been more confusing because you saw all the good things happening leading into the end of the year. With the political landscape, we were getting everything we were hoping that we would get. We were getting the air cover from the regulators. It seemed like it was on a one direction straight up. And then all of a sudden the air came out of it and we saw 46% drawdown from the high again. And yeah, you're right, Matt. It did feel like this was the deepest, darkest bear market, even though it's been a very limited time. We forget how short of a time frame it was since we were at all-time highs. But that doesn't always matter in the investor psyche.
Yeah, that really resonates. And I remember reflecting back now that people were searching for a villain, right? For a while, it was Jane Street. And before that was an offshore hedge fund. And then it was CZ. And they're this cascading cast of characters. And the reason Bitcoin was down was because people who held it sold it. And that was like the thing that the industry couldn't deal with, that people who held it sold it, which drove the price down. So you're absolutely right. Maybe it was because we didn't have a single thing to blame that some people felt despair.
Well, it quickly becomes an education session in capital flows and the impact of capital flows in kind of a fixed supply contained ecosystem like Bitcoin. Right? It's part of what generates that volatility to begin with. And it's why that education has started happening around volatility is not equal to risk. Right? Volatility when it comes to Bitcoin is the result of capital flows on a fixed supply, right? If there's a huge amount of demand to the upside and the capital's flowing into Bitcoin, you can't get any more coming into the market, right? The miners can only mine so much of it. You can't boost that supply up to absorb that demand. But to the other side, you get the same thing going the other direction. We get volatility both directions. So when capital's fleeing, you might not have anyone under there on the bid that's willing to pick it up. And in a low supply, it can be very impactful. And as more and more people are holding on to coins, using it as that store of value, and they're not out there trading freely in the market, putting two sides into a market, that volatility can actually increase over time. I see that we saw kind of a compression in volatility. People were actually getting very scared that the volatility was flattening out too much. One of your former colleagues highlighted it quite a bit. Jeff Park was always talking about how the next bull cycle really couldn't be here until the volatility returned. And I think he's absolutely right. But what also happens as that supply, it goes to people like me that don't want to give it up and view it as a long-term asset, and others that are holding on to it, you've got less free float out there in the market. And so those capital flows can actually have more of an impact on it. So volatility can actually pick up. And I don't think we've fully seen the impact of that yet. But when you start seeing, Saylor, I don't know if he picked up 14,000 Bitcoin today, he's getting some of that supply from those original holders you were talking about that are using this as their opportunity to rotate out and buy mansions and yachts and jets or whatever it is that they've earned here by being willing to stomach volatility over a long period of time. That those dynamics can shift in the market very quickly. And I'm kind of excited to see when the capital comes flowing back in. We've got a lot of macro headwinds, obviously, that seem to chop us at the knees pretty regularly when we start getting momentum, but uncertainty doesn't last forever.
So everyone's expecting that kind of the 4-year cycles in play, we're going to hit the bottoms in October. Do you think that STRC changes this timeline?
I'm not saying that we're going to get a bottom in October.
So no.
Yeah, tell us. Then I have an alternative view that actually pushes it forward. But you go first, Ben.
Interesting. Yeah. So I am looking at it where I think the downside is actually going to start to shallow. Where we do start to see a difference in these drawdowns, and I don't think that the timelines are necessarily set in stone. I'm not a believer that the cycle has to follow the timelines that the prior cycles did. I think that there is an anchoring mechanism to it, and I do believe investors trade around that because it has been so predictable in the past. So it can create somewhat of a self-fulfilling prophecy if enough capital believes that that's what's going to happen. But I think what's really interesting now, particularly when you look at a product like Stretch, which is a fixed income product, and we have one as well, SEDA. Fixed income, and I'm sure we'll talk about this more when we talk a little bit about 60/40 portfolios, but fixed income has historically been kind of a risk-off play. And this is a different impact in the Bitcoin market right now, because Bitcoin has historically been so risk-on, right? It's moved with risk assets, it's gone up, it's gone down, it's been more volatile than most of the risk assets, but it's always largely moved in lockstep with the risk assets. When you now have a product in the market that people could view as a more risk-off asset because of the over coverage on the balance sheet, the amount of support behind these, the long-term nature of the dividend reserves that are in place around these products, people can be going risk-off and going to the fixed income products, and that capital is still moving now into Bitcoin. So I think that can create a dynamic where we actually have a shock absorber that's building underneath Bitcoin, where that risk-off capital looking for the fixed income returns instead of the high volatility returns for Bitcoin can start actually putting a bid on it, because you've got a strategy, you've got a Strive, you've got all these companies that are out deploying that capital moving into the fixed income products into Bitcoin, the spot asset. And as we see those scale, which we're just starting to see, a lot of people are quick to call products, a success or a failure before they've even been in the market for a year. But with what we just saw over the past, several weeks here, where you've got billions of dollars of volume a day trading in an asset like this, and on a day like today, where this is the last day people could have bought to get the dividend, tomorrow's the ex-dividend date for Stretch, so you had a huge amount of demand coming in, it means that the seller was strategy, right? Most people are not going to sell that product on the day before they're going to get the dividend, so they're probably going to hold it through the date, which means strategy was absorbing a lot of that demand. And that's putting a huge amount of capital out there on the bid on the other side of Bitcoin. And if we see this trend continue, we look at Stretch and it's what, 6 billion right now, I think. Maybe it's 8 billion. I can't remember what the exact notional outstanding is on it at the moment. but it's growing. But relative to the market it's trying to address, it's hardly scratched the surface yet. I mean, we're talking trillions of dollars of capital that's out there. That's the TAM for these types of products. And so seeing $1 billion trading a day, this soon into this product's lifestyle is remarkable. And it shows that there are huge demands out there in the market for double-digit yields. And I think that is a signal that shows, what's coming for an asset like Bitcoin. You can only sustain this amount of buying pressure for so long before something has to give. And I think what's going to ultimately give is going to be the price. And it could be more violent than people are expecting on the volatility to the upside during this next cycle. But, we've got to work through some of these macro headwinds. But it feels like every day that we start to get good news, the market starts seeming like it wants to break higher than what it has been for the last little while. And I think with this demand on Bitcoin, and if you get the shock absorber from the fixed income capital, the risk off capital going into that product, coupled with a rebound in risk assets, I think you could really see things move pretty quickly.
Well, then I more or less agree that I think you could see things move really quickly. The point I was going to make, and then love to touch on Stretch, is I don't think the winter started in October. I'm like the only person that believes this, but I think the winter started in January of 2025. And the reason for that is if you exclude assets that had institutional capital flows through ETFs and through corporations, which were Bitcoin and ETH, they all went straight down starting in January. And they ended the year like down 70. I mean, it was a slaughter. And if you look at OG wallets, they began selling in January. I really think the winter started something like January or February of 2025. And it was papered over by this institutional bull market in suited capital coming into the crypto markets. But the traditional retail crypto market, I think the selling began at the beginning of last year. And partly for that reason, I think it's reached exhaustion, which is why you've seen those wallets flip to starting to allocate to the space. So I do think we're closer to the end than the beginning. I think Stretch is one part of the new wave of demand and a big part of that, and related fixed income securities for the reasons Ben talked about. I think there's this other piece too, which I wouldn't discount, which is the institutional capital is still coming, right? Morgan Stanley has launched a Bitcoin ETF. Goldman Sachs has filed for a Bitcoin premium income ETF. Bitwise had its best quarter in history. The institutional capital coming for long only or option overlay exposure is extraordinarily strong as well. So I think there's reason to believe both the winter started earlier and therefore is closer to exhaustion. Remember, we got to record levels on the fear and greed index, right? So the indications were at exhaustion. And now we have these multiple catalysts of new capital coming in through fixed income, through all these Wall Street firms emerging, through the continued process of ETF sales from family offices, from central banks. I actually think a catalyst, what's happening in Iran, is actually a long-term catalyst for Bitcoin as well. So I think it's lined up pretty well. I'm pretty excited.
I also think it's been completely overlooked just how impactful something like a Morgan Stanley ETF is. Not because Morgan Stanley has an ETF, but because of the advisor network Morgan Stanley has and the incentive structure that puts into place, right? If you think about the way that a company like Morgan Stanley would make money out of their investor network, it's usually going to be some fees on top of the book value that each of these advisors have. You've now got a second component of that where if any of those customers were in another Bitcoin ETF, they came out, they were undercutting fees on their ETF, effectively allowing their advisors, to roll into their own ETF as the lowest cost option in the market while potentially, tax loss harvesting along the way. So they gave their advisor network a really good way to talk about the ETF, but it also now gives it a little bit of air cover. Right. It was one thing when Morgan Stanley wasn't really involved in Bitcoin at all to be an advisor and to be willing to go out and talk to your customers about Bitcoin. When a firm like Morgan Stanley puts their stamp on an ETF and they say, we're putting this product out, we're going to put it out under our own banner, that gives those advisors a different level of air cover to start talking about it as a component of your portfolio allocation. And so that's effectively putting a 15 or 16,000 person network of advisors out there with the ability to go start having these conversations with their clients. And that's just going to continue to expand. Matt, I know you're on the road every day talking to RIAs about, Bitcoin and trying to get them up the learning curve. So, it's a tough process, right? It's a tough learning curve because all of these advisors, and my dad's an advisor at one of the big places. So I grew up in that world too, is what I thought I was going to do for a living. But, it's tough to change from what's worked for you for decades. And I think that's the hard mindset shift to have. And if you looked at a 60-40 portfolio that worked for so long, but you have to think about why it worked and what's changed today, right? We've effectively been in a 40-year bull market for bonds. If you go back and you look at where rates were in like the 70s, you had a 15%, 10-year rate. And so bonds coming out, you had really high rates on the bonds, and the only way that those were going to go was down, which was going to make those bonds perform really well. And so for a lot of people that entered these markets, they had this 40-year bull market for bonds, but now rates are collapsing to about zero, and those returns have kind of been squeezed out of that portion of the portfolio. So it's going to force this new era of advisors to rethink how they allocate client capital for the long term, right? What really protects you now? Does that provide you the same risk-adjusted returns that it's provided over the last 40 years? The answer is probably no. We're in a very different regime than we were then. And so if you start looking forward, you've got to start looking for what's going to work for the next 20 years. And when things are changing rapidly, it means your options for assets are changing rapidly. And the assets that might meet the needs of a portfolio have different characteristics. So if you think one of the largest threats that's out there to your portfolio is going to be this debt crisis and monetary debasement, and you're underallocated to certain assets that's going to provide you a return that's less than the actual devaluing that's happening in the assets, that's no longer going to be tenable for customers. This is getting highlighted, and clients are starting to ask that question. They're starting to understand monetary debasement. For the last 20 years, it never really came up. It really just wasn't an issue that they were overly focused on. But getting through that initial hurdle and looking at an asset like Bitcoin, which feels so foreign in that environment, and particularly in what they've been able to sell for so long, that's hard work. That doesn't happen overnight. That happens because guys like Matt have to, leave their house for 50 weeks out of the year to go and knock on doors and help educate and handhold and ask the questions. And there's a tail on those questions, and you've got to be available. So mobilizing an investor or an advisor network like Morgan Stanley, having Morgan Stanley potentially, I don't know if they're doing this, but put down some education information to help educate that advisor network on Bitcoin, on the ETF, that goes a long way because they're managing a lot of capital.
I'll just throw in. Oh, sorry. Do you mind if I throw one thing in, Dana? It's too fun.
Yeah, absolutely.
Okay. I completely agree with that. It is extraordinary. Like, these are extraordinary things. Morgan Stanley putting its name on an ETF is an extraordinary thing. To take another firm, Charles Schwab put out guidance on crypto in a portfolio and said between 1 and 8.8%, if I remember right. 8.8% from Charles Schwab. That's incredible, right? A few years ago, it was like begging people to think about 1%. But I think a lot of the reason is actually what Ben talked about. We did a study where we looked at the long-term capital market assumption reports that leading financial firms put out. These are the report that every major Wall Street institution puts out in November or December, forecasting 10-year returns on asset classes. And the average return in nominal amounts for U.S. equities, what Wall Street thinks U.S. equity is going to return, is 6.3%. And what it thinks bonds are going to return is 4.8%. On an average nominal basis, they're talking about a 60-40 portfolio delivering 5%. The reason advisors are looking at things like Bitcoin, the reason they're looking at things like Stretch, is that 4 or 5% on a nominal basis before you account for inflation is not going to cut it for American families. It's just not. And so that's why you're starting to see all these major wealth firms think about an asset that at least, our long-term capital market assumption has it at 28% CAGR for the next 10 years, right? You need to take on new and different types of risk if the core 60-40 portfolio is printing 5% before inflation. It's just not going to work the way it has for the last 30 years.
I would also, or go ahead, Dan.
I was just going to ask if the 60/40 is retired entirely.
I mean, from my perspective, it has to be, again, because 5% nominal is not going to cut it. It's just not going to cut it, right? That is not going to make it, particularly when you have even CPI, which is understated, running 3%. You're talking about 2% theoretical real, and versus the lived experience, you're talking about declining wealth for a fully allocated portfolio. So I absolutely think it's, quote unquote, dead. What replaces it is a more complex portfolio, is my guess, is a more complex portfolio with more orthogonal exposures. But I really don't think, we've all lived our entire professional career, as Ben said, in an era where interest rates fell from 14% to 0, which made bonds return double digits, which may never happen again. Like the weird thing about our world is that is our lived environment. We are fish in the water of declining bonds. We don't know what the world is like when that is no longer true. We're just sort of starting to figure that out. And so, yeah, I don't think 60/40 will cut it for most people if that's the return that the smartest people on Wall Street expect.
Mike, what were you going to say? Sorry.
I was going to add that, stretch at 11.5% puts immense pressure on all the different asset classes in a way that we've never seen, especially the 60/40 portfolio, which if you add tax in there, 6% gain, especially for people who are trying to live off that in their retirement portfolio, you're in a really tough spot with the ever increasing cost of living. And I've said this for a long time that portfolio is dead, and it never made sense to me. But stretch coming online and doing what it's done is creating this dynamic where you're going to start asking, why are you putting money anywhere else when you have a product that trades within a penny, 1 basis point, and is yielding 11.5%. And it's going to really question, part of the diversification question that comes up a lot, and how you assess risk across a portfolio. And I think that's what Bitcoin in general has done, is really question and challenge the historical idea of how you diversify a portfolio. And it's going to change tremendously. And so to Ben's point, when you're looking out, 10, 20 years, you got a lot of these asset classes that are kind of dying, so to speak, and you're being challenged by a product that gets you low volatility and way higher returns than anyone's ever seen before. And so I think it's just it introduces a price agnostic buyer into the Bitcoin market specifically that we've never had before. That's been the talk for many, many years, is how do we get a bid into Bitcoin that's either from the central banks or the governments or the sovereign wealths in a way that pushes Bitcoin up and up and up. And we've essentially got it now with stretch, and it's coming from a buyer that's not actually buying because of Bitcoin. They don't want the exposure to Bitcoin in that way, not the returns, not the historic volatility of Bitcoin, but they want a yield that they can depend on, that is low volatility, sits in a portfolio that produces high yield, that replaces a lot of other things. And it's complete, in my opinion, it's completely reshaped the market. And that's why you're seeing a 50% drawdown at this point instead of the 70 to 80% drawdown we've seen in the past.
I think one thing that's important is to conceptualize why this is such a high priority topic right now. And that comes down to the fact that we've got 80 million Americans that are 60 plus. So you've got this huge cohort of the population that's moving into the part of their life where they now have to rely on the assets in their portfolio plus Social Security to be able to live. And that's why this debt crisis and the devaluation of your purchasing power, right, the erosion of your purchasing power as they devalue the currency, becomes such a problem. And when that happens, you search for alternatives. And we've all heard the saying many times around Bitcoin. We say people find Bitcoin when they need to find Bitcoin. And until recently, not a lot of people needed to find Bitcoin. Things were working fine. Portfolios went on to autopilot. It was fairly commonplace how you would structure it. You were told over a long enough time period, you'd average, 10%. If you had a equities loaded portfolio for the first part of your career, and then you'd, whittle that down as you went more risk off. But you need to live on that fixed income portion of your portfolio, or you're drawing out of the principal, which can kind of spiral things for you. And so I think that there's a reason why digital credit started to get so much focus. And I think it's just ramping up right now. And it's because it's a different type of on-ramp for Bitcoin. Even if you were a believer in Bitcoin, if you're 60 and above, the 40% that used to be allocated to fixed income, if you started taking that and moving it into, alternative assets, and you put Bitcoin into that bucket, it's still hard, even if you have full belief in the asset, to be willing to stomach the volatility of it and to watch that base that you now rely on to live your life fluctuate in such huge terms. For those of us that have been in, we've become kind of numb to volatility because we've been on this road for so long that it doesn't really bother us. But if you're looking at, taking draws out of your portfolio, and you're taking a draw at a time where you see that balance is way down, that feels different. And so for a lot of people right now, I think that the credit instruments that are being built on top of Bitcoin is going to be the most comfortable entry for them, right? You're effectively right now getting better than equity returns in a fixed income security. And that is a really attractive value proposition. Now, I think that the demand in these is going to ramp up significantly over time, and they're variable rate. So you'll see a lot of the yields probably come down over time here, but not enough to where it's probably going to be below, the devaluation of the currency. But when you can blend that into your portfolio, if you've been holding, bond funds that are paying you 4.5% or 5%, and that's what you've been drawing on, and you're now able to blend up that average and get another 1% or 2% out of your portfolio, that's meaningful to the quality of a retirement, right? That's another trip with the grandkids. That's bringing them to Disney. It's going out to dinner with your friends, right? It's living a more enjoyable quality of life. And for other people, I think it's often overlooked that being able to take risk is a luxury. And I don't think that gets thought about too much. When you have excess capital, you're able to go out the risk curve and take more risk. But if it's foundational to your ability, to survive and live the quality of life that you want, taking risk is hard, and it feels like you can't lose. And so for a lot of people, that's uncomfortable. If you haven't understood that volatility doesn't equal risk, and you don't have the same time frame that you're willing to sit to let that asset perform and use all the advantages that are built into it, that could be uncomfortable. So that's why I think that the digital credit products are starting to get so much uptake. I also think it's actually going to become a big on-ramp to individuals wanting direct Bitcoin exposure. We originally thought, and this was back, when the treasury sector was the only thing that had a cycle last year, but we originally thought that now when there was equity exposure to Bitcoin, that would be an easy way for people to go and try out the exposure. But when you did that, what you were really getting was a first taste of the volatility, but on an amplified basis, which is very uncomfortable to a lot of people. And so I think that it actually has the opposite effect if you start there, where you see these major drawdowns in your portfolio. It scares you away from the asset. You're not willing to dig any deeper. I think right now, when you have a product out there like a SATA, like a Stretch, that's providing you something that's of so much value to your current situation, it helps you go to that next step and go, what is the asset that's making this possible? And how can I learn more about that? Because if it's good enough to support this product that's bringing me real value in my life, that might be something that I want. Or you might see, as these portfolios rotate to the next generation over the next, 15, 20 years, that those are the people that really want to hold Bitcoin in their portfolio. They've got the longer time frames, they're able to stomach the volatility. They've seen all of the economic factors play out over time. I just think we're in a really transformative period here where people are looking for answers. And when it comes to replacing the income portion of your fixed income portfolio, there's not a lot of options right now. Bonds have kind of dominated that for the last 40 years, and there's not a lot of better options at the moment. So they're looking for anything that can help them replace the value that they're losing out of that portion of their portfolio.
So, Matt, you've said before the launch of the Bitcoin ETFs that was the Bitcoin's IPO moment. So, can you elaborate on that? And do you think we're early to Bitcoin, or are we not?
Oh, we're super early to Bitcoin. It's not, look, I think we're early to Bitcoin until it's as big as gold. After it's big as gold, then we can talk about what's next with its improved fundamental characteristics. So yeah, it was absolutely the IPO moment. By that, I mean, it was sort of the moment that unlocked institutional capital into the Bitcoin market in a major way. There was, of course, institutional capital in the market before June 2024. Bitwise was formed in 2017. We'd been selling into that market for 6 or 7 years at that point. But it's very hard for that market to allocate in the absence of regulated financial products. And that opened up the market to the institutional world. And what happens when that happens is two things. First, you do get some volatility as you have people who were early investors want to exit. You see that in every IPO. I think that explains some of what happened recently. But over time, you just get a massive influx in assets. We actually have a really good example, which I don't know why we don't talk about more in crypto, but was the gold ETF launch in 2004 in the US. And the thing about the gold ETF launch that people don't talk about is when the gold ETF launched in 2004, the entire market was $2.5 trillion. That was the size of all available gold in the world. It was $2.5 trillion. It was not broadly held in any institutional portfolios. It was hard to access. Today, that market is $36 trillion. And part of that is that the advent of financial products, including ETFs, and then other derivative products on top of that, brought the bulk of the world's money into the gold market. That was one major contributing factor to go from 2.5 trillion to 36 trillion. If you look at Bitcoin, when the ETF launched, it was about 1.5 trillion, right? Maybe a little bit less. The same thing is going to happen, just faster and to a larger scale. So yes, it was absolutely the IPO market, brought institutional capital in. We've seen this movie before. We know what happens. It follows basic math. And every indication is it's happening again in Bitcoin, from the growth of new and novel products, including the credit products we're talking about, to major institutions allocating, to major institutions launching their own ETFs, to major institutions starting to recommend not 1%, but 2, 5, 8%. It's just like literally every point in the story that you would have hoped is happening. And what that means is it's going to be an asset class measured in tens of trillions of dollars, not in single digit trillions. That's the story we're on. So yeah, if people can stomach the volatility, to what Ben said, I think they'll be in for a very good return. And for others, there are other products now that give them differentiated exposure.
So you guys are all, go ahead, Mike.
Matt, do you think, given that strategy getting too big, it means they're going to fail?
I don't know. I mean, I love strategy as a Bitcoiner. There is a point at which I think they're big enough and should sit there. So I do think that's the case. And of course, with these credit instruments, you have to play against the size of the asset base versus the size of the credit. That is the toggle. My experience watching strategy over the years is that they are very aware of those toggles and very cognizant of them and disciplined, but they will need to continue to be disciplined. We can't fool ourselves that if they suddenly become undisciplined, it can't introduce risk into the market. Of course it could. But the track record of discipline has been pretty good. And the good news is it's all public and monitorable. So my answer is no, I don't think that will happen. But if it does happen, we will see the train coming and be able to evaluate it in real time.
Yep. Ben and Mike, do you think strategy could control too much of the Bitcoin network?
You want to go first, Mike, or you want me to?
You can go.
Ben, you can go.
Sure. I think it's going to be hard for them to get to that point. I think that we've been conditioned here right now, watching them able to buy during this time period where Bitcoin hasn't really seen it's seen significant adoption, but not to the levels that the addressable market would allow for. And I think we're starting to see the signs of that come up. And you even hear Saylor himself saying, yes, I got to this percentage of the Bitcoin network, but for me to get to the next one, it's going to take exponentially more capital for me to get there. And so that puts some rate limiters on the amount of acquisitions that he can do on Bitcoin, which I think is going to serve a purpose in kind of controlling the size that's going to be out there. Right now, I don't think they're anywhere near controlling too much of the network. I know that becomes a narrative quite often, but I don't think that that's the case. Are they ever going to get to be 20% of Bitcoin's market and hold 20% of the coins? I don't think they can get there. I think by that time, the capital is going to be too great to be able to rise to those levels.
I would agree. I think the capital required, I think they're going to transition tremendously to using Stretch as the primary buyer of Bitcoin rather than the common ATM like we've historically seen. So, I think that's going to come in waves with the ex-div date. It remains to be seen how it plays out over the course of a whole bull market. But I think they're going to your point, Ben, of rate limiting. They're going to be controlled more on the flows to Stretch and the other credit products. Ultimately, it's going to hamper their ability to buy more. On top of the Bitcoin that, the volatility of Bitcoin when MSTR goes up, they issue common. But, ultimately, yeah, I think we're getting lulled into the 70s, the 60s, the 80s. And when this thing really goes, the dollar flows coming in aren't going to scale exponentially, I think, to what Bitcoin's actually going to rise. So when you're talking buying Bitcoin at 250, 300, 500,000, takes 8 times the amount of capital as we're seeing today to buy the same amount. And so, yeah, the diminishing returns on the Bitcoin yield is going to slow their ability. So from a nominal total coins perspective, I don't think you're going to see, a runaway train, but ultimately they're an expression of the entire Bitcoin market as a whole. The common shareholders, Bitcoin buyers, it's not just Strategy holds it, but it's kind of the market as a whole saying we're buying what Strategy is holding and their future growth. So I don't think it's a problem with the market as a whole.
So
one thing I also always like to highlight is we have no idea what this all looks like in 10 years, right? This is the strategy of today, and this is the way that they're executing today. But you don't know that in 10 years that there isn't an incentive to now deploy, right? What can a company with all the capital do with all the capital on their balance sheet? What can they do? If you're a company that's holding $1 trillion of capital on your balance sheet, what optionality do you have as a company? The answer is you have all the optionality in the world. You can be whatever you need to be for the next phase. I think that's getting highlighted right now when you kind of watch the wipeout that's happened in the software sector. The one thing that it highlights in real time is that innovation is happening all around us. The world's changing at a breakneck pace. And because of that, there needs to be a focus on the war chest for the future. Controlling your own destiny, controlling your own ability to pivot as opportunities are arising, being the person that's in place to build the rails for whatever's next. Right. So I think there's a huge amount of focus on everything that happens today and assuming that happens into perpetuity. And that's the only thing that ever happens and evolves. But as we've learned just over the last 5 years, this entire model has evolved. And because we don't know what the Bitcoin ecosystem is going to look like, we don't know what infrastructure is going to be in place. That's all being built out in real time. I don't know what that's going to mean for a company that controls that much capital. How can they deploy that into the world? How can they create a huge amount of value and economic value in the world? I don't know yet. And that's the exciting thing about it, right? Right now, we're looking at this large issue globally where all these central banks have caused so many problems that are piling up and compounding on top of themselves that the most certain bet that we can make at the moment is that they're going to have to continue to devalue these fiat currencies, right? That's phase one. That's where we're at today. We see that train heading towards us. There's no way for them to stop it at this point. I think Doge was kind of their best chance to see if they could make a dent in that issue, and they didn't. And the debt continues to compound. The interest continues to grow. They're going to have to devalue that debt over time. And so building a capital war chest on the balance sheet in capital that has a completely fixed supply that's outside of, any nation's control is a very prudent decision. Now, as the world evolves and as more and more of these fiat currencies either collapse or maybe they have to dollarize into something and then they've got to back themselves by an asset, what does that future world look like? And that's the question nobody can answer for you yet. So what you want to do as an organization is make sure that you've got the ultimate in flexibility to be able to pivot and adapt in a very uncertain and accelerating future. And I think that that's where strategy's at right now.
So
They've
Ben,
transformed their company in 14 months. We digital credit didn't even exist 14 months ago, and this is where we're at. 1.5 billion in a single day from one product is just insane. So to your point, I think it's even trying to project out 3 or 5 years is really difficult. And all I know is in a finite supply asset that's becoming a capital base, the company with the most is probably going to be in a pretty good position to do whatever the heck they want. And it's really not going to be a problem.
so Ben, first I want to ask all of you. Matt, you can start first. What would a reasonable portfolio look like in 2035 versus today?
Oh, wow. That is, I think it's remarkably hard to forecast anything like 10 years ahead. Actually, I think Bitcoin may be the easiest of all assets to forecast, at least the one I have the most confidence in, for the reasons we've been discussing. Look, I think fiat debasement is a one-way train. I think greater acceptance of Bitcoin is a one-way train. So it will certainly have a central role in portfolios. The challenging part of your question, Dana, is like what happens to the equity market in a full AGI world is a really challenging question. What happens to traditional credit in an AGI world is a derivative of that is equally hard, because if you can't forecast what's going to happen to the traditional equity market, it's hard to forecast what will happen to the corporate bond market. If you're worried grossly about fiat debasement, it's hard to forecast what will happen in the government bond basis. So I don't know what it will look like in 2035. The base case assumption would be it is an asset that a portfolio that compared to today has more hard, scarce resources than the average portfolio does today. That's probably my best bet. Bitcoin is an example of that, but other hard assets and resources are probably a bigger chunk of the portfolio as well. Beyond that, I think it's hard to forecast that far ahead.
I totally agree with Matt. I mean, we're in such a strange time right now. And there has been the highlighting of hard assets. You've seen it in the metals. That was kind of the old fail-safe. If you were going to go into any of the assets, you go pick up gold or you pick up silver, whatever your metal of choice was. And we saw those behave erratically, which was never the case in the past, which is unnerving. Right. Normally, people wanted those assets because it was meant to outpace, the debasement of the currency, and it would rise with that. And that was good enough. It was that hedge. When you see them start to behave with volatility, like we just saw, where you get these massive peaks and these blow off tops, that changes the way people view those assets. And I still think real assets are going to be a much heavier portion of people's portfolios. Historically, you've seen real estate, people buy a home, the home appreciates over time, it becomes a significant asset that's held in their portfolio. It was the reason why you were always told you should own that asset, you should own your home so that you can benefit from the appreciation and the value there. But now people are starting to get nervous about even that, because if you're going to rent out real estate, people can't afford the rents anymore. An average wage can't buy an average house in the United States. That's a major shift, right? We've had a lot of structural problems that are causing weaknesses across the board. Same thing with equities. If you strip the M2 monetary supply growth out of the S&P 500 returns, they're effectively flat. There's been very little actual value that's been created out of that beyond monetary debasement. And so once you understand that, it shifts the way you look at everything in the world. And I think that's why so many of us become Bitcoiners and we lock in so hard. Because when you go back and you start asking the question, why did equities perform year over year, every year? Was it because they were generating so much value? Or was it because the money was getting debased, and because of that, the price on the cost of goods was going up, which meant they could raise the price of products, which meant revenues were going to go up, which meant bottom line figures were going up, and you just see this constant growth happening, and it made that feel very comfortable. But really what you're doing is you're riding monetary debasement up, right? You're just holding an asset that benefits from it. And as soon as you do that, you start searching for what is the best asset for me to express this trade. And that's the unique thing that brings us to Bitcoin, right? It's mathematical certainty in the amount of supply that's out there. And that's something we're searching for in an age where the supply of nearly everything is it fluctuates greatly, right? As there's more demand in the market, they build more houses. It's supposed to bring down the price of the houses because you got more on the market that's for sale, less buyers. You've got all these items happening out there that are changing the way people think about what they want to own. So a portfolio in 2035, my answer would be, it depends on how bad this gets, right? If they don't find a way to pivot, if they don't start taking control back over this, if they don't start making the right corrective moves, and it's above my pay grade to tell you what those corrective measures would be to prevent this. And it might just be that you can only slow down the debt problem. But I look at that, and the only thing I want to own are scarce real assets, because those are the things that you feel certainty about in the future. You don't know, but you're playing the odds. And right now, the best odds at the casino are that they're going to continue to print money, and you want to allocate accordingly.
So we're excited about digital credit, and it's new, but how does it not work? So what would cause Strategy and Strive to blow up?
Well, it's actually very simple, and I think people make it too complicated, but what you would really need to make these products not work is you would need Bitcoin to go into a long drawdown and then flatline for a decade. That's kind of how I look at it. If Bitcoin draws down to, 20,000, 10,000, and it flatlines and there's no growth, you would start to see the capital dry up out of the markets. It would dry up out of the equities. The access to the capital markets would, tie up and would shrink, and you'd start selling off the Bitcoin to make sure you continue to meet your dividend obligations for as long as you could. And if it never recovered, you would deplete your balance sheet, right? That's how it doesn't work. And so really, anytime you're getting into any of these products, your core thesis is around Bitcoin. That has to be your foundational thesis for any of these products. If you're going to build a product on top of Bitcoin, you have to have a thesis around what that long-term CAGR is going to be, because effectively these credit instruments are putting on a carry trade. It really is that simple. You've got a cost of capital associated with issuing the instrument. You're buying an asset that you think is going to appreciate in value more than your cost of capital on there. And then that excess return, is delivered to the common shares. And so that's the model. And so if you get into a scenario where some black swan event happens and Bitcoin draws down and it flatlines at low values and it forces the companies to dip into the balance sheets to meet the dividend obligations, and you start pulling out that collateral coverage, that's what breaks the model.
Yeah. I would throw in two more things without trying to tread on any shoes. The others are issuer specific risk, I think. If you had an issuer that was overly aggressive and didn't balance the two properly, and didn't understand the volatility of the market, that issuer could in fact get in trouble. If you had an issuer who wasn't staked into this ecosystem for which it was an ancillary project, perhaps, and didn't really understand Bitcoin and wasn't sort of aligned with it, I think that could be a risk as well. They may not act in a way that you want. So the other risk beyond the Bitcoin drop flatline is issuer specific risk that I think people are right to think about and underwrite.
Absolutely. You have to, if you're going to run a model like this, you have to build the entire structure of the company around weathering bear markets. I mean, that's a reality of these markets, that they're going to come, and you don't get to pick the timing. Although, as we talked about earlier, we saw some cycle dynamics play out. But when you're building these balance sheets, you need to build them in a way that you can weather a Bitcoin bear market. Like there's no coincidence that the US dollar reserve that we put in place to support our dividends is 18 months. It's the longest bear market that Bitcoin's had, right? So that's a very intentional number to pick. And we were the first issuer to come out with a US dollar reserve, and then Strategy, came out and one-upped us, I think a week later. So, but it's incredibly important, because if you're going to run this type of a model, you need to make sure that you can provide confidence to the investors that you're going to be able to meet all those dividend obligations, whether the markets are good or whether the markets are bad. And so having a structure that allows for that, and making sure you are in a position to weather the storm and give yourself as much runway as possible for when the volatility cuts to the downside, that's what helps you, survive and be a good steward of shareholder capital. If you start playing fast and loose and you start getting the itch to, I think it's going to be a bull market, I'm going to deploy my reserves because I'll have so much more money if I invested in Bitcoin right now, you have to resist that, because that's not the point. You're balancing two things, right? You're balancing credit quality. Credit, you need the market to look at you and understand that you are a good credit risk to take on. So you're balancing that story because you have a credit product in the market. And then you're also balancing the amplification on your balance sheet to make sure you're a good steward for the common stockholders. So you're doing this balancing act all the time, and you want to keep on enough amplification to give that upside ride for the Bitcoin that you're holding, for the people that want the amplified Bitcoin exposure. But you're constantly balancing that with stability and making sure that the credit investors that are investing in your products know that you've built the structure on your balance sheet to make it through any market conditions that are going to get thrown your way.
Dana, I would add, on a broader view, not the specifics of any one issue or company, but when you're talking about Bitcoin itself, I would say just nation state fiscal responsibility is the biggest risk broadly. They have to debase the currency for many different reasons, but ultimately, if they somehow were able to get balance sheets and debt under control, that would be the biggest knock to Bitcoin itself, and the whole thesis essentially goes away. But that has knock-on effects everywhere else in the market and every asset and our entire way of living. So I think the odds of that are extremely small. But for me personally, that is the thesis on Bitcoin where it breaks is, the U.S. comes out and says we're actually going to get the debt truly under control and be responsible. But I put that at a very low probability.
We say it tongue in cheek, but that really is one of the biggest risks, right? Fiscal responsibility. Yeah, the problem is we've built a structure in place where we've created economies that are built around consumerism. You need people to want to spend. And in order to incentivize consumers to spend, they have to know that their money is worth less next year than it is this year. And I think that's a weird dynamic, because if it ever shifted, right, if AI comes out and it does turn out to be this massive deflationary pressure in the market, and all of a sudden the signal out to investors is hold on to your money because it's actually going to have more purchasing power next year than it has this year, that completely changes the psychology of a consumer. Now you're willing to wait because that's the messaging. But for your entire life, you've been taught that the purchasing power that you have today is as good as it's going to get, and next year it's going to be less. Only by a little bit, 2-3%, if you believe those numbers and you ignore everything you need to actually live your life in that metric. But, it changes. It changes. And so I think that we've built this system that's so reliant on that model that their ability to shut off the spending and become responsible and to slow this down has passed them by. Now the question becomes, how do they pivot from here? What does actually happen when it breaks? And what was really interesting was when the Ukraine war kicked off and Russia got cut off from the SWIFT system, it sent up this massive warning flag to any sovereign nation, which said, if your country is completely reliant on the SWIFT system or the US dollar, you've got risk. Because if you get on the wrong side of another nation and they can cut you off from the global economy, that's a real problem for your country. So it highlighted the value to a sovereign asset or to a non-sovereign asset like Bitcoin. And you've started to see that play out more and more. You see it in Iran right now with the fees that they're wanting to charge for people passing through the strait. They're wanting those paid in Bitcoin. Why is that? Why is it that asset that they're choosing? And I think it's other cryptos as well. But I think that this issue has been highlighted as more and more countries have, dollarized over time, that's introducing a structural weakness to them because they're dependent now on the currency and the rails of another country. They're not self-sovereign anymore. And so I think a lot of countries are going to have to start looking at that and deciding, should I start accumulating the only asset of scale that's out here that's transactable? If I needed to settle trade, I could transact in value in this asset. Should I start looking at holding a portion of my reserves in that in the event that I need it if I get on the wrong side of one of these conflicts? I think that's a really interesting dynamic that's getting overlooked. But if you're leading a nation, you have to be aware of it.
Matt, what do you think the odds are of us entering a deflationary market?
Oh, a real zero, or not zero. That's an exact. I should never say zero. Very, very low. Very, very low. So I actually believe AI is significantly deflationary when it's fully robust and forming. But for the reasons been articulated, I just don't think governments will stand for it. Also, China entering the WTO was hugely deflationary. Good or bad, it was hugely deflationary. The response we made to that activity was to use it as an excuse to expand spending and to overcome that and make sure we were still in this inflationary environment. So if you look across recent history, the response to deflationary action in the modern era is just, we can print and spend more money. So even if AI is in fact deflationary and has deflationary aspects, I think I would just expect government spending to increase to overcome that. We spend that deflationary benefit. At least that's what we've done for the last maybe 40 years, certainly the last 20 years. And I think it's going to have to get really bad before we stop doing that. It's going to have to get Argentina level bad before you see like a dramatic pushback against that.
So Bitwise has done a lot of research on Bitcoin's price predictions. Do you care to share what you think it could look like in 10 years?
Yeah, sure. I mean, I'll give you the conservative base case in our long-term capital market assumptions, which is that Bitcoin will get to $1.3 million by 2035. The reason we use that when we're talking to institutional investors is that number sounds like a massive number, but the assumptions you have to make to get there are really modest. So in order to be worth $1.35 million by 2035, all you need are two things. You need to assume that the store value market, which is gold plus Bitcoin, continues to grow in the same way it's grown for the last 20 years. Not that it accelerates because we're reaching this enormous spike level in debt. Now we're running $2 trillion deficits and we're reaching the end game. So I actually expect it will accelerate. But all you need to do is assume it keeps growing the way it has for 20 years. And then you have to assume that Bitcoin goes from like 6% to 24-ish% of that combined market. Not that it overtakes gold, just as millennials and Gen Z and Gen X get older and wealthier, and as Morgan Stanley launches Bitcoin ETFs and Goldman Sachs launches Bitcoin ETFs, and we have Stretch, that its share of that market continues to grow as it has for the last 10 years. If that happens, if store value market grows as it has for the last 20 years, and Bitcoin keeps taking market share as it has for the last 15 years, you end up at $1.3 million. And that's before we consider its use in things like international currency transactions, which I do think is another major secondary market that's starting to come online. And that's before we assume that actually the store value market might grow much faster because we have such high debt loads that we're in this position of fiscal dominance that we can't get out of. And that's, before we assume that Bitcoin actually has better characteristics than gold for many applications and may in fact be a majority of that market. even these really conservative assumptions, from my view, get you to about $1.3 million. So when I referenced earlier that we think its CAGR will be 28%, that's where you get that number, is based on those two assumptions. Gold will continue to grow. Bitcoin will take 25% of the market. If we get that, it's $1.3 million. Could it be higher? Of course. Could it be lower? Of course. But that's our existing price target.
So 1.3 million by 2035. Ben, is that in line with what Strive thinks? And Mike and Dustin, what do you guys think?
Yeah, very much. I mean, Matt's on the exact same train of thought that I am. I've got a 1.25 over 10 years target. And I found that it's really not worth forecasting anything under 10 years. 1 year, way too short of a time frame to try to forecast. You're looking for a long-term trend here. You've got to be able to factor in some of those, macroeconomic conditions that are out there. But you've got the wild card, which is what we just talked about a few minutes ago, about the different way people start to look at their portfolio, and things can change really fast. So I view 1.25 million over the next 10 years as a base case, and probably a low base case, because I think that there's enough surprises that could be there to the upside that it could be much more significant than that.
Yeah, I would agree. At 75,000, a 25% CAGR for the next 10 years puts us at about 700,000. And that's after a 50% drop. And so that doesn't factor in all the digital credit products, all the ETFs, all the other financialization of Bitcoin that we haven't seen before. So we've been in I'm of the opinion that we actually haven't been in a bull market or seeing, a typical bull market for 5 years now. I don't think, 109 in January of 25 and 126 in October of last year really was a true bull market in the sense of what we've seen historically. And we're going through a period of tremendous transfer of assets from longtime holders, people 10 plus years in the space, who are finally like, okay, I'm sitting on tens, hundreds of millions of dollars, billions in some cases, or some of them that just has to work itself through. And now you have a whole new holder base coming in that's looking on a 10 to 20 year time horizon. So I think, I truly think it's going to surprise people to the upside.
Dustin, what do you think? Do you have a price prediction?
Higher, much higher. I remain probably the most just relentlessly bullish person across all of this stuff that I know. I think all of our price predictions dramatically undersell the speed of it's funny, I think as Mike was talking about, we're at $39 trillion in debt. Printing is happening at a more rapid pace than ever. And so whatever we're predicting is probably dramatically too low.
So, go ahead.
I was just going to say, we discount the opportunity for something to break that sends it vertical. And it's interesting when you look at what happens when other currencies break, because you can go look at Bitcoin quoted in those currencies. We just happen, to live in a country with one of the more stable currencies, right? But there's been plenty of episodes out there where you've seen these periods of hyperinflation hit, and, the value of Bitcoin quoted in those currencies stovepipes of what happens if that shows up for, the global reserve currency. We don't know. So, we're all, as much as I'm, a Bitcoin maxi on all of this, and I think that Bitcoin's going to win in such a big way, I'm not rooting for it to win in such a big way that the dollar has to break and that has to be the expense of it. I don't think people are ready for what that world looks like. You're not going to want to think about the impact that something like that has, on your family and friends that are out there. Yes, it'll be good for number go up technology, but I would hope that they keep some type of control over this so that you can maintain some stability. So I want Bitcoin to win in a massive way, just not at the expense, of everyone around me.
So I'll wrap this up here in a second, but are you saying that, digital credit is unstoppable? So why are people then investing in real estate or dividend stocks?
Well, I think all investors have different tolerances and different assets that they're comfortable with. I think we live in this very small echo chamber in the Bitcoin world where we assume everybody else out there is even aware of these products. And the more I get out there and start talking to people, I'm having a what is that conversation over and over and over again. So most investors don't even know that they're an option so far. And it'll start to become more apparent as the market size scales up, as you see more and more assets come into these products and they start gaining more traction, more coverage, more analyst research. It'll start making its way to them. But right now, I just think that we're so early in this journey that you actually have to be in and or around the Bitcoin ecosystem or have someone in or around the Bitcoin ecosystem that's helping you even become aware here. But it doesn't mean that investor behaviors are going to change overnight. For a lot of investors, Bitcoin's still a very early stage asset that they're not willing to rotate out of what they've, been allocated to for so long, even if it comes at a lower return, because they don't themselves understand what the risk is with Bitcoin and they don't know how to quantify that. So what is the risk adjusted return for them? If you're unfamiliar with the asset and the characteristics and you haven't dug into the network and, the security around it, you can be uncomfortable. So I think that we're still in a transitionary period here. But over the next 5 years, I think 2 years from now, we'll be having a very different conversation. And I think that these credit products are going to become far more mainstream than they are today.
So we'll wrap this up. But before we go, I want each of you're in an elevator with one person and you have 1 minute. I'd love your elevator pitch on Bitcoin. Matt,
someone else go first. I'm formulating my pitch.
Okay.
So that means Matt's going to get the most polished one. So I'll be the first one that goes crude. They can't stop printing money. Bitcoin has a fixed supply. That simple.
Yeah,
Wow.
I would say that as well. I like to meet where people are, and the most relatable thing for them is their bills and the cost of everything is continuing to go up, and especially for younger people, their ability to buy a home for their family is decreasing dramatically. I think the current rate is average first time home buyers like 40 now, and so you need an asset that will scale long term and keep you above the cost of living increases. And the only asset that can truly do that is Bitcoin.
I love it. Do we get Dustin or
Dustin, do you want to go? Yeah, we'll give you some more time to prepare.
Magic internet money that has become pristine collateral. You can't lose. Number go up. Let's fucking go.
That's what I was just going to say. You're going to say magic internet money. I should have said that.
We have to remember where we started. You got to keep it alive.
I love that. I love that. It's hard to top any of those. I mean, the other thing to note for people if they haven't encountered Bitcoin before is look, it's just part of the market now, right? Stocks are $110 trillion. Bitcoin's $2 trillion. If you're not at 1.5%, you're off the market. So I don't know. Maybe Harvard's endowment and Abu Dhabi Sovereign Wealth Fund and Stan Druckenmiller and Ray Dalio and me and Ben and Mike and Dustin have no idea what we're talking about, but you're taking a pretty big bet if you're at zero. Maybe just get to at least to what the market is telling you, which is like 1% or 2%, and that's neutral. If you want to be bullish, add more. If you want to be bearish, add a little bit less. But zero is just wrong. It's just not where the market is. So that's a good place for people to start.
Well, thank you so much for coming, Matt, Ben, Mike, Dustin. I really appreciate you guys. And thank you for everyone listening. We appreciate you sharing and liking. We do these shows every Tuesday at 6. So make sure to follow all of these guys. It's an honor to have you. Thank you again. And have a good night.
Thanks for hosting us.
Thanks, Dana. It was fun.
See you, everybody.
Arch Lending is building the most transparent borrowing experience in crypto. Get industry-leading rates from 8.49% APR, borrow against Bitcoin, Ethereum, or Solana, and receive USD or USDC within minutes. Your assets stay protected with qualified custody, no rehypothecation, and verifiable segregated addresses. As your collateral grows, unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never on your own. Arch Lending, simple tiers, public pricing, market-leading rates at every size. Check them out at archlending.com/debates. Again, it's archlending.com/debates. Use code debates to get 50 basis points off your APR on your crypto back loan today.